I'm Michal Slate. I'm a financial advisor for Road Credit Union. I'm a certified financial planner, and investments is kind of my world. So I'll try not to speak over anybody's head, and hopefully everything I say is easy to understand. So, okay, so the presentation is titled Uncharted Waters. It's about, the current shocks in the market and how we can navigate the stock market volatility in a coronavirus world. So here's my intro page. I'm Michal Slate, certified financial planner, financial advisor with Rogue Investment Services. And there's my contact information if you want to reach out to me off of this call, but I'm pretty easy to find if you want to ask me questions offline. I totally understand that financial things can be personal. So what is happening right now? We want to review how the market has behaved over the last 10 years, but with all the events in the news and related market volatility, you might be wondering, how are these events impacting my investments? And so this chart shows the growth of the S&P 500 index over the past 10 years through March 31st of this year. March 31st was kind of the worst part of this whole stock market downturn so far. And the S&P 500 index measures the stock performance of 500 large companies listed on stock exchanges in the United States. Although investors cannot directly invest in the index, the S&P 500 index is seen by many as a representation of the US stock market. So that's why I'll be referencing it throughout this presentation. So the average annual return of the S&P 500 over the last 10 years, as of March 31st, which includes this current crisis, has been 10.53%. That's the average annual return. But as you can see, up until recently, we've been so fortunate to experience this bull market where the market continues to go up, that some investors who have just started investing recently, they've never experienced a significant downturn, or they've never seen the market go down like it has. And it's not surprising that a lot of investors, their emotions are running really high right now. So here we are today, that little magnifying glass. So I'm going to dissect that little magnifying glass a little bit so that you can see what's going on right now. So it was December 31st when the coronavirus disease was first reported from Wuhan, China, and January 20th when other countries, including the United States, started confirming cases. January 30th, the World Health Organization declared an international public health emergency, and the cases are being reported outside of China at this time. 3 days later, the first coronavirus death was reported outside of China. Then February 24th, the US stock market started to really go down over the coronavirus fears after the Dow Jones average index experienced the worst in 2 days, the worst day in 2 years. And then the World Health Organization declared a COVID-19 pandemic, and the Dow Jones entered bear market territory, which is 20% average decline. The S&P 500 index entered the bear market territory on March 12th after President Trump announced the travel ban on most European travel, which raised the prospect of worldwide economic slowdown. And the Federal Reserve on March 23rd announced new measures to support the economy. And then on March 29th, Trump announced CDC guidelines will be extended through April 30th. The combination of the coronavirus outbreak and oil prices, which wasn't expected, caused this all to be really unprecedented. And it's still too early to tell how this is going to play out, how it's going to impact the economy. But we do know that volatility can cause investors to act on their emotions and that lessons learned from the past can help us navigate these uncharted waters. So today in this presentation, I'm going to talk about the current shocks in historical perspective, and then a little bit about what's going on in our heads and why this is so traumatic feeling, and then how we can live with market volatility. So some strategies and some ways we can avoid the pitfalls that we often fall into during times like this. So first off is the current shocks in a historical perspective. So we want to put things into historical perspective because it helps us gain perspective so that these things, they make a little bit more sense. Most investors know that the market goes through cycles, but it's in times like these when the markets are really stormy that emotions are running so high. A historical view focusing on relevant research, solid data, and proven strategies can really help put these current events into perspective. And even though the past doesn't guarantee what the future is going to look like, it offers that valuable perspective that we need. So let's look at the past. This chart shows the growth of the S&P 500 since 1970. It illustrates the history of bull and bear markets. Bull is when it's going high, and bear is when it's going down or staying down. In this illustration, a bear market is defined as a 20% decline from the peak. And a bull market starts when the previous contraction has reached its maximum drawdown and continues until another 20% decline or more. So highlighted is the negative, or when the bear markets happen. Most recently, negative 34%, but we've seen this before. But what happens when we're not experiencing that is the positive that happens in between the bad times. So you can see that if we look at the big picture, we can draw these, interesting conclusions. You can see that bull markets have lasted much longer compared to bear markets. And the average gain during a bull market was larger than the average loss during a bear market. So in fact, it's really interesting that over this period, the average bull market rose 396.9% and lasted 7 years, 4 months, while the average bear market fell 42% and lasted 13 months. So this history of bulls and bears tells us that market declines are just a part of investing. They are inevitable, they happen frequently, but they don't last forever. So for example, market corrections, when the market goes down is a market correction. Market correction of 5% or more has historically happened once every 10 months. And the last time it happened was August of 2019. A market correction of 10% or more has historically happened once every 2 years, and that happened December 2018. A market correction of 15% or more has historically happened once every 4 years, and that was in December of 2018. A market correction of 20% or more historically happens every 8 years, and that is what we're experiencing today, what we have seen in March of this year. So to put another thing into perspective, we have seen smaller viral epidemics in the past. So nothing like the coronavirus, but what about history of smaller viral epidemics can we learn? Smaller viral outbreaks are not new to the markets. While markets react to the news events in the short term, they have tended to reward patient investors over long periods of time. For example, we've got in 2003, the SARS virus saw 8,000 people infected, and it was brought to an end by good hygiene, hand washing, and warming temperatures environment. And then it burnt out when enough people became infected to build an immunity to the disease. In 2009, there was the swine flu. I remember getting that, not fun. And in 2014, we had the Ebola in West Africa with human intervention. It ended, and the World Health Organization declared a coordinated international response. So countries worked together to administer to the sick, and then a second outbreak occurred in 2018, but treatments were developed from the first outbreak. They were offered to patients, so that was good. And then 2015, we had the Zika virus, which brings us to today. There is nothing like the COVID-19 virus. It's unprecedented, and it's different. It's different than past epidemics and past global economic crisis in that it has caused a global economic disruption, triggering responses by governments around the world. It has severely restricted economic activity, travel globally, and we don't know how it's going to play out from an economic perspective. So it's a new virus. So with all of that going on, it can be very scary. And what's going on in our heads? Let's explore that. At the end of the day, we are all emotional. And when volatility strikes, many of us feel like we're riding a roller coaster. So let's find out what's going on in our heads for a little bit of psychology and science. So with our brains, when we make decisions, our frontal cortex processes lots of information to make a logical and informed decision. Usually we do this really well. It's where do we want to eat? What do we want to eat? What clothes do we want to wear? What kind of toothpaste to buy? It's the quickest route to get to the store or to work, and you get the idea. But then there's this little part of our brain known as the amygdala. It's often referred to as the reflexive brain because it connects stimuli in the world around you to experiences. So while your frontal cortex gives us a logical response, our reflexive brain acts on emotion. To best explain this, let me show you an example. So remember the caveman? The amygdala may help when confronted by a saber-toothed tiger. The saber-toothed tiger is the stimulus. Based on past experiences, the amygdala would tell the caveman that now would be a good time to run. In fact, the amygdala is often associated with that fight or flight response. But when we let our reflexive brain control our reactions when making financial decisions, it may lead to undesirable outcomes, to say the least. So I'm going to explain a bias and something that happens to us a lot. It's a concept called anchoring. It's a behavioral bias, and it is the tendency to focus too heavily on one piece of information when making decisions. So anchors have a powerful hand in our decision making and can create unrealistic expectations for most investors that fall for this. And so a survey went out and we asked investors to tell us their average annual portfolio return expectations over a 5-year period. And the median response, or the average response, was 10%. Most investors that were surveyed said that they would earn about 10% over 5 years. But then they were shown a hypothetical, they were presented with a hypothetical market that was up 20% in any given year. So then investors, they shifted their average response to 20%. Then the introduction of a hypothetical 20% made them anchor to that, and now they expected that 20% return. And then later, when those same investors were presented with a hypothetical market that was negative 20%, the average investor surveyed decided that they would earn 3% when the market was down 20%. So it's interesting that when you do this, it's very illogical. These investors expected to outperform a down market by 23%. Market's down 20% and they're still going to get 3%. It's a psychological kind of mess that happens. So now let's see how anchoring can influence the way we feel about an investment plan. So imagine that you invested $10,000 in 1989 and setting a goal to earn 8% average over that period of time. So here's the goal you set. You put in the $10,000 and you wanted to earn 8%. So that's how you kind of think in your mind that it's going to go. And you would have earned $100,627. But the reality of the stock market is that things don't move in a smooth fashion. After a few years, when the market hits a new high point, it's easy to anchor at that high. So even though the market is messy, if we're anchoring, we're going to lock in that high point, which is what a lot of investors did this over the past few years, as they locked in these high returns and didn't expect it to ever go down in their mind. And so they anchor. And then if the market drops, you might feel like you've lost, like you lose sight. And even though you're actually still on track to meet that original goal, you feel like you've lost something really, really important. So it's important to keep focused on your long-term strategy and not let the anchoring that may come with short-term volatility steer you astray. That pivots into loss aversion. So this is a pain that we associate. There's a pain that we get when we lose something. Loss aversion is another fear-induced behavior that a lot of investors experience. It can be defined as our preference to avoid losses because the associated pain is much more intense than the reward that we get when we gain something. In fact, studies have shown that the pain of a loss is twice as strong as the reward from a gain. So fear can drive us to do all kinds of things, but one thing we know from being in this business is that fear will drive you to cash. For example, when the dot-com bubble burst, investors panicked and pulled their money out of the market. If you've done this, you are not alone. It's what a lot of people do. And this contributed to an increase of $491 billion that moved into cash during that time. And then a similar movement occurred during the global financial crisis just a few years later, with investors pulling $943 billion into cash. To avoid more losses in today's markets, investors are tempted now, and we're seeing it now, to move money to where you think it's going to be safer. But what emotional investors, which is most of us, right? We do this. We don't realize that the security does come at a cost. So if you look at the average money market account yield since 2000, you'll see that while the yield bounced around a little bit in the beginning of the decade, it's been close to zero for over 10 years, for the past decade. And you may be surprised to learn that once inflation is factored in, that's the cost of living, staying in investments you may consider more secure while you wait out the stock market volatility may in fact lead to erosion of your purchasing power. So over the last 19 years, average money market account yields on an inflation-adjusted basis were only positive about 15% of the time. The positive yields in 2009 and 15 were largely due to periods of deflation when the economy is not doing well. So lots of information. How do we live with all of this? What are some strategies we can do to navigate these uncharted waters, right? So as we've seen market volatility as part of investing, what can we do today? So let's look at 3 strategies that can help you live with the market volatility. The most important, this is something that really makes the difference between someone who's panicked and someone who's not, which seems like common sense, but it can be done intentionally, is just stay calm. Keep a long-term perspective. And as you've just seen, a lot of investors, when they're faced with volatility, they act on fear and pull their money out of the market, diverting them from their long-term goals. So suppose you put to work $10,000 again into the S&P 500 on December 31st, 1970. And several market events occur. There's historical events that take place during this time. There's the energy crisis, Black Monday, tech bubble burst, global financial crisis, and now COVID-19. But by staying the course, your $10,000 investment would be worth over $1 million. You would have averaged that 10% return. Even though, again, past performance can't guarantee anything is going to happen in the future, but it helps when things are shaky to look back and know that we've come through this before. So sticking to these fundamentals is sometimes easier said than done, though, really. So the next one, other than staying calm, is to tune out the noise. So don't over-review your portfolio. Once you have your goals, once you put your investments in place, don't watch it every day. It'll drive you crazy if you watch it every day, is what I tell most of my clients. A way for investors to stay calm and not act on emotions is to tune out the noise. And so if you have access to the chat, it'd be interesting to see if you want to put in there how often you view your portfolio. And I can talk about that at the end. It's interesting to see what others say. Do you look at it every day, every week, every month, quarter, or once a year when you talk to your financial advisor? Okay, moving on. So stock markets rise and fall every day with many ups and downs throughout the day. This may cause anxiety to those who keep their eyes fixed on the daily market movements. The more they watch their portfolio, the more they lose. Suppose you were investing over a 10-year time horizon, your perception of your portfolio would change depending on how often you looked at it. If you were monitoring on a monthly basis, you would observe a loss 38% of the time, even though over a 10-year time frame, it's been positive 91% of the time. So during your regularly scheduled review of your portfolio with your financial advisor, try to focus on your goals and your time horizon and all of those things instead of the numbers so much. It's helpful. And diversification matters. I know you've heard this before, but diversify. What does that even look like? If you have your money in cash everywhere, it's not diversified. Diversification means investing in different asset classes. So investing in energy, stocks, bonds, technology, all of those different things. There's healthcare. There's so many things which I'm going to show you. It's a staple of investing. It's essential. Diversification also may reduce a portfolio's overall volatility and provide a smoother ride through bumpy markets. So this chart can be a bit overwhelming, but it illustrates the need for diversification. You can see how each one of these colors is a different asset class. And it shows how the various asset classes performed on a year-by-year basis over the last 15 years. The best performing asset classes for each calendar year is at the top of each column, and no asset class has consistently offered the best return year in and year out. For example, let's look at the emerging market stock, the EM stock. If you had invested in 2005, 2006, or even 2007, you would have been feeling really good. But if you had put all of your money into this bucket in 2008, you wouldn't be feeling so good by the end of that year. So it would be better to diversify, to spread out your investment and spread out your risk. Some other strategies when it comes to investing that people will do, there's three here. One is asset allocation, which I'll talk more about, but then investing with the losers and chasing the winners. People who try to time the market or try to invest on their own, they'll have some of these strategies. So let's consider those three strategies. How would you have done? Investing to chase the winners, that's investing in last year's best performing asset classes. And then investing to chase the losers, so investing in last year's worst performing asset classes. How would you have done with an investment and then at the end? And then asset allocation. So just being diversified. So it's interesting because you think that some of these really smart strategies would do better than just picking a good diversified portfolio and then leaving it alone and just rebalancing with your advisor. So in addition to helping reduce overall volatility and improving your chances to earn more consistent returns over time, keeping assets properly allocated across several asset classes does help to avoid the temptation to try and time the market. And then in addition, as markets change, your portfolio does need to evolve. So times of volatility offer a great opportunity for you to reevaluate and possibly rebalance your portfolio. So remember your strategy, because especially when markets turn south, we have to keep our emotions in check. This slide shows how the market goes up and down even while you're staying invested and doing pretty well. Short-term losses, though, they trigger anxiety, but letting emotions drive your investment decisions, they can get costly. So one key to living with market volatility is focusing on long-term results rather than the daily bumps along the way. It can be difficult though. So in the chart, the blue bars represent the largest declines from a peak or a high to a trough or a low that occurred each year. So despite the intra-year volatility, the S&P 500 index had positive year-end totals 25 out of 32 years when you're looking at 1988 to 2019. So it's interesting that volatility, while challenging, can represent some of the greatest opportunities to buy in your portfolio. One more topic I wanted to just touch on is dollar cost averaging. So with the market going up and down, a lot of investors will invest like monthly or quarterly even. And so by doing that, you're buying at different prices while the market's up and the market's down. So most people are quick to agree that mustering the discipline to make purchases during a volatile market can be difficult though. So dollar cost averaging is committing to a fixed amount at regular intervals to invest. So let's look at an example of $500 that's invested every month. As you can see, you buy more shares when the prices are low and fewer when the prices are high. In this example, your average share price over a 6-month period is $10, but your average share cost is only $9.77. So the results are that the average cost of your shares would be 23 cents less than the average price of your shares over that period. So by dollar cost averaging, if you're not sure you want to go all into the market, by picking a dollar amount and then investing monthly, you can ensure that most likely you'll average a better price than others, potentially. And it can definitely help reduce anxiety about the investment process. So you should consider your financial ability to continue purchasing through periods of low price levels and economic conditions. It can be hard to keep investing when the market goes down. So when markets become volatile, a lot of people try to guess when stocks will bottom out. In the meantime, they often park their investments in cash, but just as many investors are slow to recognize a declining stock market, many also fail to see the upward trends in the market until after they've already missed the opportunity. So missing out on these opportunities can take a big bite out of your returns if you're trying to time the market. Just missing 10 days of the upside when the market recovers is a huge difference. And then 20 days, 30 days. In fact, trying to time the market is almost impossible. Let me show you one more slide on this. So this chart shows the 20 worst trading days and the 20 best trading days. So to buy a stock and to sell a stock is trading, or to buy an index or a mutual fund. In many cases, the best trading day immediately follows the worst trading day. So let me show you how on March 16th, it was the worst trading day, and then on the 17th, it was the best trading day. And then March 12th, March 13th, September 29th, September 30th, and you can see this. Very interesting. So the key takeaways, that's pretty much it for the presentation. I'm just going to summarize here. So history has shown us that while markets react to shocks in the short term, they have tended to reward patient investors over long periods of time. Our emotions affect decision-making abilities in times of market volatility. Behavior bias, such as anchoring and loss aversion, may lead to some undesirable outcomes. 3 strategies to live with market volatility are stay calm, diversify, and remember your strategy. So I do hope our discussion today has helped make sense, at least, of the current markets and the behavioral biases that may affect our financial decisions. So if you have a financial advisor, I would encourage you to think about scheduling an appointment with them and talking about your goals and how your investments line up with that, and give you a greater sense of confidence, I think. And so if you don't have a financial advisor, think of the fact that a sudden drop in the market can have dramatically different implications for someone just starting their career compared to someone nearing retirement. So what's important is that you understand your situation and your financial strategy, and that you have some support. So think about, for health-related goals, studies show that people who regularly work with a personal trainer, a nutritionist, or a doctor are more likely to have success. Why? Because a personal trainer can help you build a long-term strategy to achieve your goals, keep you motivated, and ensure you stay on track with your regular sessions. So similarly, working with a professional with finances like myself can help you build a long-term investment strategy. Keep emotions in check, keep your biases in check, and stay on track with regular portfolio reviews and adjustments.